Welcome to the first of a multi-part series on how to use Solana DeFi. Now, we get a lot of questions about how we're able to generate above average yield, above the staking rate yield. And to us, it's pretty simple. You just deploy your assets into DeFi. But that's because we've been operating in the space since DeFi started. And so we've been playing around, all of us on the team, personally, and in some cases professionally, since the very beginning. And so what we've done is we've taken that collective knowledge and put it to work here, generating above average risk adjusted yield for our balance sheet and ultimately our shareholders. But many shareholders rightfully ask, well, how do you do it? And so this series is going to pop open the hood on some of the ways that we generate additional yield. Now, we're not going to go through everything, and this shouldn't be seen as a how-to video, but more as a primer, a way to get started. And we do certainly encourage people watching to jump in yourself. All the things that I'm doing today are accessible to the average person. All you need is an internet connection. It's very easy and accessible to do, and that's the beauty of DeFi. So today we're going to go through Kamino, which is the largest lending platform on Solana, and it's kind of the bedrock of borrowing and lending across the Solana DeFi ecosystem. So to get started here, we have the Kamino platform. And what I've got loaded up is a wallet with about $1,000 worth of Solana. And so we'll kind of run through each step, each and every step, and how to go about doing some activities here. So the first thing that we're going to do is we're going to showcase how to lend out your Solana and collateralize it. So to start off with, we've got $1,000 of Solana. We're simply going to loan it out here. So we can see Kamino is currently paying 4.11% with some USDG incentives, some about 9% rewards each week from USDG kind of pair-wise borrowing, but you can think of the main rate as 4.11. So we're going to go ahead and supply that. And we're not going to do all. We're going to keep a little bit in our wallet to pay for fees and so on, but we'll do the majority of it. Actually, I'm going to do a round number here. Just going to do 6 SOL. Okay, so we're going to deposit 6 SOL. And it's going to pay a small fee to open the account, but once the account is closed, we will get that back. Okay. So here we go, confirming the transaction. And it is now complete. Great. So as we can see here, we have now lent out some SOL. If we go to the portfolio tab, we'll see we've lent out the SOL here, 6 SOL, and we can see what it's yielding. So now what we're going to do is we're going to do a borrow. So we're going to go in here and borrow some Pi USD. Right now, the borrow rate is 2.32%, and there's a lot of capacity still left in the market. It's only about 15% utilized. Okay, so we're going to borrow, and we're going to keep it simple. We don't want to have a liquidation here. The price of SOL moves against us. So we're just going to simply borrow $100 worth of Pi USD. Great. So now we can go to my wallet. We can see we have a small amount of SOL left and about $100 of Pi USD. We go to the portfolio tab here. We can see what we've got. We can see our LTV. Right now we're about 12% LTV. Once it gets to 75%, there will be a partial liquidation to get us back into line. So now the question becomes, what do I do with the Pi USD? Well, a couple things you could do. You could, of course, turn around and borrow more SOL, and this would give you some leverage. And you'll notice here the borrow rate, 2%, is lower than the yield rate, 4%. So there's actually a spread there. You're actually going to get paid to take on leverage right now, which is pretty cool. But another thing that you could do, certainly much lower risk, is you could turn around and lend out the Pi USD or swap the Pi USD into another stablecoin and lend it out. So let's take a look here at some of the different rates offered by some of the different stablecoins. And these are variable rates. They move around, of course, and they're not always the same, and they move around fairly frequently, actually. So checking in on this is pretty important, but we'll actually see some automated methods on how to do this in a bit. Okay, so what we can see here is that USDG is actually paying 5.62%, which is pretty good. So we're going to go ahead and swap the Pi USD for USDG, and then we're going to lend it out. Pull up Pi USD, and we're going to do USDG. So we're going to swap 100 Pi USD for 100 USDG, 1 basis point fee there. So go ahead and swap this. Great. Now I should note we're using Jupiter here. Jupiter is the primary DEX aggregator or liquidity aggregator on Solana. And what's cool about it is it guarantees best execution. So we can see here, this swap was done through the stable swap, but at any point in time, different markets might give different prices, and you might be able to split up your order across multiple different markets. And each market, oh, and see, look, it just changed. And now the best price was available through the OKX DEX router. And so at any point in time, the best price is going to be moving around and the venue is going to be moving around. And so Jupiter guarantees that you get that best execution. Now, for that, sometimes you pay a fee, certain assets, certain pairs, they add a fee on top, others they don't, but it is a great way to guarantee that best execution. Okay, so let's go back to Kamino here. And now we've got $100 worth of USDG yielding 5.6%. We're going to go ahead and supply that. So now we can see here, got $850 roughly of SOL collateral, $100 Pi USD loan, and $100 USDG supplied. So now what you'll notice here is we have a net APY of 4.5%. And if you netted these out against each other, you generate about 3.3%. And this is what I would call roughly a risk-free yield. Yes, of course, there's smart contract risk. And yes, of course, Pi USD and USDG could, in theory, depeg. Pi USD being backed by PayPal, USDG being backed by a number of exchanges, including Kraken. So there is certainly some risk there that these things depeg. However, given that no major non-algorithmic stablecoin has ever blown up, I think it's a safe bet that these two will maintain their peg in the long term. And so what you're doing here is you're capturing a essentially risk-free 2.3%, or sorry, 3.3%, 330 basis point spread. And your SOL is still generating some yield. Great. So this extra yield, 330 basis points, you could stack on top of the yield generated on the collateral, the main collateral asset, and that would be a way to juice your yield. But now, the SOL here is not generating that much yield. The stake rate 6.5%, so 4.1 is not as great. And there's a way to increase the yield with only slightly increased duration or risk. So let's go ahead and do that now. So what I'm going to do is I'm going to withdraw as much of this as I can. We'll do 5.5 for now. This is going to cause my LT fee to go up quite a bit. Okay, so I pulled out a bunch of the SOL. So now what we're going to do is we're going to go to Sanctum. And we're going to do some staking here. Got some Sol. I'm going to connect my wallet. We'll see here we've got 6.42 Sol now. Some of the leftovers from before, and then the 5.5 that I withdrew. We're going to go into our favorite LST, DFDVsol. For quick reference, if we go to the Explore tab here, DFDVsol is yielding about 6.5%, a little over. It's one of the highest yielding LSTs out there. Of course, you got Infinity, which has some swap fees built into it, but it's not one of the collateral assets on Kamino. So it's one of the DFDVsol is one of the highest yielding major collateral assets on Kamino. Okay, so let's go back to stake. Put the 6 Sol in, and we're going to buy DFDVsol, or rather, we're going to stake to DFDVsol. And let's check which route is the cheaper route. It looks like the direct deposit is in fact a better rate. So we're going to go ahead and do that. Great. Okay. So now we've got 5.72 DFDVsol, and we're going to supply it here. So we go down to the list of markets on Kamino. You can see here about 62 million DFDVsol supplied. So we're going to go ahead and add to that. Great. So now got this asset added. Now I should note real quick, the LTV rates, the liquidation LTV rates. Sol at 75% is higher than DFDVsol 55%, but is lower than the other stablecoins at 90%. We'll get into this in a little bit when we talk about how Kamino works and some of the structure, but I wanted to just roll up my sleeves and jump right in for those that are most interested in hands-on. Okay, so we're going to go ahead and withdraw the remainder of this Sol loan just to clean things up a little bit. Sorry, the Sol collateral, rather. Okay. So now we've got DFDVsol as collateral. Now it's earning 0 yield directly, but it's yielding 6.5% via the underlying staking rewards. So if you notice here, this is paying 4.11. The other's paying about 6.5. So we picked up an extra 250, 240 basis points of yield. So now what we have 6.5% yielding on DFDVsol, and then another 330 basis points on this spread here. And now, of course, it's not one-to-one, right? This is only, at this point, 10% of the, or a little more, 11% of the portfolio. But that's an extra way to generate, let's call it an extra 30, 40, 50, maybe even 100 basis points of yield to stack on top of the 6.5%. So that's an interesting way to generate some additional yield for pretty minimal additional risk. Now, of course, we need to be rebalancing this, right? If this borrow rate goes up or the lending rate, supply rate goes down, then we need to move this around. But we have monitoring systems in place to alert us to these changes. Okay, so that's how that works. But I want to go through another strategy real quick. So we're going to go ahead and withdraw the USDG and close out the stablecoin arbitrage here. So I'm going to pull this out. And we're going to go ahead and swap it. Get rid of the USDG, get some Pi USD back. All right, we've swapped back. So I'm going to go back over here, repay with wallet. Great. Okay. So now what we've got is a single piece of collateral with no positions borrowed against it. So another strategy that can be deployed in addition to the stablecoin arbitrage is the stake looping trade. Now, how does this work? Well, remember, we're generating about 6.5% yield on the LST right here. And actually, we're generating more ourselves because we also generate the validator profits that come off of it. So ourselves, we're actually getting somewhere close to 7% all in because we run the validators that sit behind DFDVsol. So 7% here. And you'll notice we can borrow liquidations at 6%, which is pretty interesting. Now, rather than doing this manually, I'm actually going to use the multiply product on Kamino, which just simplifies this whole looping strategy. So we're going to go to Sol loops here to filter out, and we can see DFDVsol here. And the maximum yield is 10.5%. So how does this work? Well, pretty simple. We go back to the borrow tab. If you remember, the LST DFDVsol is yielding, go my positions here, is yielding 6.5% for most folks, 7% for us at DFDV. But we can borrow liquidations at 6%. Now, what's the extra risk here? Well, the LST, if we want to get out of it, if we have a small amount, a few $100, no problem, we can just get out. But if we need to get out of our entire position, we're going to need to unstake. We're going to need to pull it out, and that's going to take a full epoch. Now, if the epoch's about to turn in an hour, then it's only going to take an hour. And if the epoch's going to turn in, 2 days, it just turned, right? And we got to wait the full epoch, then it might be up to 2 days. And so to unwind this position, unwind this trade, it could take up to 2 days. So we're adding roughly 2 days or maximum of 2 days of duration to this position. So a very slight duration mismatch. Now, how does this trade potentially go wrong? Borrowing a bunch of SOL to then buy more DFDVsol to then post that as collateral, continue the loop. Well, it's predicated on the interest rate being the spread being positive, right? So it's predicated on us being able to generate 7% on the LST and being able to borrow SOL at 6%. Now, if that inverts, right, let's say borrowing SOL gets really expensive, and this typically occurs during like spike periods where there's high demand for SOL, then maybe that borrow rate jumps to 20 or 30%. And then our yield rate's only 7. Well, we now have a negative net interest margin, and it's going to start to eat into our equity position. And the more leverage we have, the quicker it starts to eat into it. But you can certainly unwind the position in, a maximum of 2 days to kind of quote stop the bleeding there. And over time, this trade has worked out quite well. So we're going to go ahead and put this trade on. So we're going to apologize. We're going to pull this out to properly do the full loop function. And you can also do this natively within just this borrow function, but we'll just do the multiply function to simplify things. So we can see here we're getting our DFDVsol back, and we're getting the rent that we paid to open the account back because we're closing the account. Great, okay. So now we're going to go to multiply. I'm going to go to DFDVsol here, and we're going to max it out. We're going to put it all in. 5.7. And leverage, let's go a little crazy here. Let's go to 5x leverage. So we're creating the account. Actually, I'm going to go ahead and do the max. All right. It's saying there's a small discount. I think this is more just a pricing, slight pricing deviation. But regardless, we're going to do 5x leverage here with the full balance of DFDVsol. So we can see the net APY is going to go to about 9%. But remember, that's based off of the 6.5 number, not the 7 number. So for us, for most folks, they're going to be generating 8.9%, which is still pretty respective or respectful rather. And we could juice it all the way. We go up to 7x and get this number to north of 10. But for us, because we're generating that, let's call it 50 basis points for easy math of extra yield. And if we've looped it, let's do this, 5 times, then we're generating an extra 250 basis points there. So we stack 250 basis points on top of 9%, and we're at about 11.5%. Okay, so let it find a suitable route to do this trade. Okay, so now we're going to use the multiply function here. So we're going to multiply at 5x. We're opening the account here, so depositing some of the SOL for the rent, and then starting the loop. And what this does is it simplifies the process. So it's going to post the DFDV SOL as collateral, borrow some SOL, then take that SOL, buy more DFDV SOL, then post that as collateral, then borrow more SOL, and just kind of do it quickly, all atomically, all in one transaction, rather than having to do it manually back and forth and back and forth. It's a pretty cool function that they've built in to the product here to allow for this type of activity. So we can see here now the net APY, it's moved a tiny bit. We're here at 8.88%, which is, again, quite a bit above the 6.5% staking rate. Great. So now we're on our way to generating significant yield. We can see some information about where the rates are at. And we can see some historical information as well. There's a bunch of great portfolio management tools built in here. All right. So let's go ahead and wind down this trade and get back to just straight SOL in my wallet. And then I'll spend a little bit of time talking about Kamino and what it is and kind of the theory behind what makes this whole thing work. So we've got our position here. We're going to do withdraw. We're going to max pull everything out, which will get us basically to 0. So we get our rent back. All right. So we can go to the portfolio tab, and we should have basically nothing left. Let's make sure here. Here we go. On the portfolio tab, we are all zeroed out. We're going to go back to Sanctum. We're going to unstake. We've got DFDVsol. Unstake it all. We've got two options. We can do instant or we can do delayed. Now, instant effectively amounts to selling DFDVsol into the market to buy back SOL. And there's always people out there willing to buy and sell with a certain amount of liquidity. So you're going to take a little bit of a price hit, but not too much, 11 basis points. So that's not too bad. On the other hand, you can do delayed, and this is the process by which you actually convert the DFDVsol into the underlying SOL via an unstake. And as soon as the epoch turns, you get your raw SOL back. So for large balances, this is typically the better way to go. Let's put in 50,000 here. You can see delayed, it's 10 basis points. That's it. If we did instant, it's going to be a little bit worse. You can see the price differences here. And if we went really big, let's say 500,000, 75 million, we can see the liquidity is drying up here. But since we just have a small amount and we want to close things out for the demo here, we're going to go ahead and do the instant. We're going to lose about 90 cents worth of value here. And now we're finishing up the demo with where we started. I'll refresh my page here. Pull Phantom up. There we can see roughly $1,000 worth of Solana and no other assets. So we've round tripped 2 different trades within the Kamino DeFi platform or lending platform. And these are 2 ways that you and us can generate additional yield on our SOL. If we know what we're doing, we have some of the infrastructure in place to monitor these things, to hold the balances securely, and to deploy actively on chain. Okay, so taking a step back, how does Kamino work? What is Kamino? What are the base functions? What are the base primitives here? Essentially, what's going on is this is a collateralized lending platform. So this is the exact same thing that your brokerage does with, say, margin loans. And this is kind of the one of the primary underpinnings of the entire global financial system is margining systems. So what that means is if you want to borrow an asset, you have to post another asset as collateral. So that if something happens to your loan, there's something there, the collateral, to repay the loan in the event that you default. And this eliminates the need for credit scores, for evaluation of someone's wherewithal to repay, all of that, because it's secured debt, it's secured credit. So the foundation here is post an asset as collateral, borrow any other asset, and then if the collateral value drops too far, then you either need to pay back the loan or the collateral gets taken over and sold to pay back the debt. And these systems have been around since 2020 and they've survived an entire bear market. They didn't blow up in the FTX blow up in the last cycle when it was all the centralized lenders that were doing unsecured loans, across with each other. The DeFi platforms were totally unaffected. They kept on ticking. They stayed intact. People could always borrow and lend from them and to them. And so this is the beauty of DeFi. You could always see at every point in time where these positions are at. So one great example is looking at the positions, you can see the total supply and then total borrowed. So you know how much of each asset is in these in the platform. Now, another component is the liquidation LTV. So each asset, based on its volatility, is given a discount to its fair market value, if you will. So what this means is if you have, say, USDC as collateral, you're only being given up to 90 cents on the dollar before your position is liquidated. Now, why is that? Well, in the event of a market stress environment and your collateral is taken over to be sold, the only way the platform guarantees that it doesn't become under collateralized is by being able to actually sell the asset to purchase whatever the asset of the debt is, if that makes sense. And so in a stress environment, we feel pretty comfortable that USDC is not going to depeg by more than 10%. It's only ever once depegged by more than that, and that was over the weekend, a weekend with the Silicon Valley Bank crisis. And so we say, hey, you know what? This is probably pretty good. Something like Solana, on the other hand, is much more volatile. And so while the liquidation event is nearly instantaneous, there still could be some stress on the asset that might cause that, few second period between the trigger being hit and the actual sale of the asset. There could be some additional movements in the price. And so we want to build in, or the Kamino platform rather, wants to build in a lot of buffer. So we can see here that's why Sol is discounted 75%. An asset like Bitcoin, a little bit more liquid, a little bit higher LTV. Additionally, these markets have caps. So each asset is capped at certain levels to reduce the risk of any one asset depegging, creating issues for the whole market. Now, additionally, what many of these DeFi platforms, these DeFi lending platforms do, is they will separate markets entirely. So you'll notice here in the main market, the Kamino main market, with almost $3 billion of assets, it's mostly kind of your blue chip assets. It's some stables, it's some Sol, some BTC, and LSTs, which are all basically just Sol. So these assets are hyper liquid and easy to sell as collateral if needed. However, there's other assets that people want to post as collateral and borrow against. So Maple or Syrup USDC is a great example. It generates pretty high yield, natively about 6%. And so you might want to borrow against it to, for example, generate some more yield to do some leverage on it. But Syrup USDC is a somewhat centralized backed project. There's a few more question marks about its long-term peg. It's not been around as long. A whole host of reasons why it might not achieve the grade A or top tier collateral status. And so it's been placed into an isolated market. So here you have about 100 million of Syrup USDC supplied, and then a number of stablecoins that you can borrow against it. Now, what you'll see is that the borrow rates are a little bit higher. And so, for example, the lowest borrow rate is Pi USD at 2.74, but in the main market, it's 2.32. Now, the beauty of these isolated markets is that, let's say, God forbid, something happened to Syrup USDC, the thing blew up. The only market that would be at risk would be this market here. And so it'd only be the people that have lent money, loan money out to generate yield on these stables that would be affected, which would suck. This would be quite a bit, about $100 million. However, the main market would be safe, no problems there. And so this is a way to further isolate the risk for a little more esoteric assets and give people the choice. Hey, do I want to lend, if I have plain dollars, do I want to lend against these blue chip assets and generate, let's say maximum 6% yield on Pi USD? There's some incentives there, which is why it's so high. Or maybe I want to go all the way up to 8.3% with USDS and generate even additional yield. Or maybe I really want to go down market, and let's see the altcoin market here. Yeah, nothing great there. Sanctum market, just Sol. Let's go to the Solstice market here. Oh yeah, this is a juicy market. So here in the Solstice USX market, we can see if you lend out USDC, you're generating 16% yield. Now, there's not a whole lot of supply here. So if you lent much at all, this rate would collapse. And I'm not super familiar with EUSX yet. And so I may not feel confident piling into this position, lending out, even though the rates are juicy. I may not be confident that this can't depeg, and then I would, lose a portion of my money. So this is how these different pools on Kamino work. There's different levels of risk behind all these assets, and then correspondingly different levels of yield and borrow rates. Now, one of the cool things that Kamino has built in is these lending vaults. So if you remember PyUSD, if we go back to the main market, PyUSD was generating about 6% lending yield right here, which is great. Backed by the main market, we've got some rewards there. But if we go to the lend tab here, we can see the Centaura PyUSD vault at nearly 10%. Now, what does that comprise of? We can see here it does have some Kamino rewards in there. So maybe you say, well, the Kamino token is not going to be worth a lot. So you have to discount that and think about, how much you think that's actually going to be worth at the time that it's liquid and you're able to sell it. But setting that aside, what do these vaults do? Well, let's pop this one open here. It's going to allocate your PyUSD across multiple of these markets, and it's going to continuously rebalance for you to give you the best yield. So you don't have to check it every day. So let's take a look here and see how they've allocated it. So we can see here they've allocated the PyUSD 65% to the main market, 25% to the Maple market, which we looked at earlier, and 10% to the JLP market. Now these are generating less yield right now, which is why they're smaller. And they probably have some risk parameters in here that no more than a certain amount can be in a particular market. So let's go look at a different one. Let's go look at the Prime, the USDC Prime. Actually, let's look at the Gauntlet Earn vault. This is using the Cash stablecoin. And we can see they've lent it, again, mostly main market, but it's generating a higher yield in the Maple market. Got some pretty good yield coming off this one. Along with the Kamino rewards on top, generating close to 12%. And again, this vault is going to be auto-rebalanced. So we can see here the reallocations. Okay, so we can see some of the reallocations here. Some of the actions it's doing. It made some trades just a little bit ago. And moving coins around to optimize that yield for you. Now, right now, they're not charging a fee, but some of these guys will charge fees over time. All right. That's a quick bit about how Kamino works. It's a collateralized lending platform. And this is a primitive that is foundational to all of DeFi. So this was pioneered by Compound and Aave back in the early days, but this same model is applied to and modified to varying degrees across basically all of DeFi. It's one of the foundational primitives for building alternative financial markets or new financial markets on top of these decentralized networks. So this is Kamino. So we'll be back with additional episodes in this series covering different DeFi protocols and ways to generate yield on chain.